One of the biggest lessons I got from Mark Douglas, the author of Trading the Zone, is how to deal with randomness and uncertainty in trading. How to know when you have many losses that things will turn around and you have multiple winning trades after. How to know that your edge will play out over time. And how do you know that you will make money when you seem to be losing money right now in the market. And how to stay consistent with your habits and your routines to then be able to make money long term in the market. As part of our Desire Trade Academy program, recently we hosted a mastermind call on that specific topic of randomness and how to be able to deal with it, how to get comfortable with being uncertain in the market. And so Michael Toma is really one of the best guys I know to teach that topic, apart from Mark Douglas. He's someone who had a lot of experience with randomness for his career in trading over 20 years now. And there's a lot in this we can learn in terms of mindset and psychology to be able to become better traders. So this was a paid training for our academy, but I'm putting part of it here on YouTube for free so you can have a look, see if you like it. And there's going to be a link below if you want to check out more the academy and how we help traders to level up their trading this year. So without further ado, let's dive right into that training.
Let's talk about the math behind randomness. But first, let me read you a little story. And that story, of course, is from, you see it backwards, of course, but all right, Trading in the Zone, the Bible. All right, so let's talk about what Mark Douglas thinks about randomness. A couple things to think about. If a large enough number of hands are played, trades, blackjack hands, whatever it is, the patterns will emerge that produce consistent, predictable, and statistically reliable outcomes. The best traders have learned and completely accept the fact that they don't know what's going to happen next. More importantly, they don't need to know in order to make money consistently. Okay? That's why I cringe in the Slack chat when I hear somebody use the word think. Well, why did I think I thought it was going to go up? One last quote, and then we'll go back to story time later. As a result, if you focus on execution, it's easier to stay focused, right? Keeping the odds in your favor and executing flawlessly, right? Which makes you less susceptible to making mistakes, right? The best traders stay relaxed. So how many traders in the room and maybe, listen to this on the recording are relaxed when they trade? Well, the best ones stay relaxed because they're letting the probabilities just play out, right? They can't control that, so they're just letting them play out. And all the while, these profitable traders know that if they have enough edge in their strategy and they execute properly and their sample sizes are big enough, which we'll talk about in a second, they will come out net winners. That is what we're going to talk about today, right? This shift in focus to letting trades just play out. So what is the math? We'll go to the slides. What is the math behind this randomness thing? Okay. Well, when you get into a trade, there are unknown participants during the trade that impact the outcome. When you push the button to enter a trade, what happens after that is unknown. Buyers come in, sellers come in, right? We have no clue and we can't control that. That unknown participation creates this randomness that has a large impact on each trade. Again, we don't know what it is going to be. We can't control it. Kind of scary when you think about it. So how can traders best traders sit back and just relax or go play golf? Like Mark Douglas said, the expected results normalize with more occurrences or more trades, right? The casino's framework for profitability is based on this. Just get more people into the house, get more people playing. More occurrences, the more we can assume that the results that we expect will happen. All right, let's go to the next slide. Okay, so let's look at, and for those who are statistical experts and have education in statistics and accelerated math, these sort of distribution kind of curves that you'll see, or you'll be very common. Okay, but for those who are watching the recording, maybe not familiar with this, I'll walk you right through it. Okay, so this is the typical result on a small sample size. But like Mark Douglas said, we need a valid, bigger sample to make sure that what we expect will be the outcome. So in the case like this, we have 10 trades. You can see the outcome is somewhat kind of random and has a little bit of a bell thing looking there. But for the most part, it's kind of pot luck. Okay. It's like flipping a coin, which should be 50-50, but it could happen, 2 heads, 8 tails, vice versa. All right. So we see that sort of inconsistency playing out. Can we make some valid statistical trading edges based on that type of outcome? Not really. No. The randomness, like we talked about, where once you push the button, the participants that we don't know about come into play on a sample of, say, 10 trades, small sample, pretty much anything can happen. And the randomness is really playing a big role in your outcome. So let's look at the next slide. We'll see how this gradually changes. So let's look at the left. All right, we had our 10 trade snapshot, right, on the far left going top to bottom. That was the slide that we just looked at. What happens after a greater sample size, right, of 25 trades? Do we see sort of this curve starting to form a little more defined? That is showing us that as the more sample, the more we put in, more time we push the button and execute our strategy, the more accurate the result will be to what we expect. Let's not talk about wins and losses or anything like that. It's getting more precise on the outcomes of what we expect. Now let's look at 100 trades, really starting to see some definition there, right, in that little curve. All right. And then on 250, which quite honestly, I think it probably should be more normalized, you see that the outcome, right, is bell curve, is kind of the peak bell curve, is the top of the bell is what we expect. And the outcome is very similar to what we expect. On each trade, remember this, on each individual occurrence, the randomness was present. But if you go back on the 10 trades, it's kind of all over the place. Randomness had a pretty big say on the ultimate part of the outcome of the 10 trades, the summary of the 10 trades. But when you look to 25 trades, 100, 250, and look to the right with 500 trades, all right, you get that skyscraper kind of bell-shaped curve. Basically, what that's saying is, even though every trade, every occurrence had the same amount of randomness, some more, some less, whatever, the law of this probability is that after a greater sample size, the expected outcome is very close to the actual outcome. And then what happens is if we plot it on sort of a linear type thing, and again, won't get too much in statistics here, but think of it like an equity curve, okay? The outcomes, which is the little stars there, the red stars, and the line is what we expect, right? If you notice, there's relatively little noise. It's kind of hugging that line, right? That's basically saying is what we expect to happen is what happens. And again, important, it's like the 4th time I'm trying to mention this now, is each individual trade had randomness, had participants that we didn't expect, right? We had no clue. We had basically no control. We just let the thing play out. If it's a little confusing, that's okay. I don't want to get too crazy on the statistical part, because I know a lot of the people in this room, a few people probably teach this class, but let's remember from a trading perspective about randomness and how we overcome that thing that we can't control. All right, let's go to the next slide. So let's think about and this is not, I'm just not going to go through these takeaways real quick. I just want to make sure we understand the value of this randomness, okay? And then maybe it's a good time to quote another Mark Douglas quote here. In trading, the unknown variables are other traders who have the potential to come into the market and put on and take off a trade. We talked about that. Since all trades have an uncertain outcome, we want it to have a certain outcome, but it's basically uncertain. We're basically at the hopes and praise of the market because we can't control anything else after entry other than risk, obviously. So if there's this randomness that just is happening, how can we get into an outcome that's exactly what we want, which would be, the edge, as you call it, in trading? Okay. If we just play it out and have enough occurrences, right, have enough sample size, let it randomly distribute. Sometimes traders are going to come in and slam us. Sometimes they're going to take us to the promised land. We have enough occurrences, right? The odds of the success for each individual trade proportionally will be in the trader's favor, assuming the strategy has an edge. By the way, this is for the recording. If anyone wants to go back and has trading in the zone, this is around page 106, 102, 106. Here's one of the takeaways. I'll just read it from Douglas. Right? Traders have learned, the best traders have learned, that all they have to do is keep the odds in their favor, a strategy that has edge, have enough sample size of events, trades, so that their edges have the ample opportunity to play out. I cannot, Mark Douglas just nails this topic, absolutely nails it. So let's look at the bullets, and I want to hear your thoughts and feedback on this thought and idea, and maybe what you did to overcome some of these, the sample sizing challenge that sometimes we have. Okay, first, randomness is a part of trading. You cannot eliminate it. Just the nature of markets. You cannot eliminate it, but you can minimize its impact. Okay, we just talked about the few ways in which you can do that. Right? But what happens a lot of times, and I see traders that, well, this market got me, and all these things, or Goldman stepped in and started selling. It's kind of all BS. I mean, it may be true, but the randomness is something that we need to accept. And I will tell you this, a lot of times I see traders that just give up purely because of this thing. It's not that they're losing trades or whatever. They couldn't accept the randomness, or maybe their account size and their trade size didn't allow for the randomness to play out. That's where this risk of ruin kind of shows its ugly head. Okay, next, we can increase occurrences by lowering trade size and or increasing product diversity and strategies. What's the goal here? What's the takeaway? We need sample. We need occurrences. We need a valid sample, enough occurrences, so that bell curve will come to play, to shape. And if we have a strategy with edge, the expected return will be what we expect, similar to our back tests and what we're doing. Okay. So how do we get those occurrences to increase? Because I hear it all the time. I see it in Slack, and I talk to people, had a rough week. Oh, really? Is everything all right? Or, I know there's a lot of things going on in the world. Oh, no, I just, I had like 3 losing trades in a row. It was weird. And so how many trades did you take? 5. Okay. Well, clearly they're talking about something that there was no occurrences. There wasn't enough valid sample. So we can increase the occurrences by lowering size. All right. So what happens is you want to keep that size extremely small. So it allows you to have enough occurrences and allows you to absorb, downside, drawdowns and things in bad streaks that randomness sometimes give you. How do we do that? Well, often I see we need to trade more products. We need to trade different pairs if you're in FX. Look at a bigger range. Stick to the big 6. Maybe you go beyond that. If your strategy is in your development, maybe it opens up to some equity products, some liquid, products in the equity markets, such as the SPY or things like that. All right, or maybe even commodities. I often say, I really sometimes, when I trade something like an ETF, which is a US based kind of like hybrid product that trades on exchange, I got to tell you, sometimes I don't even know what it is. I traded something the other day, the IYR or something. It's a real estate ETF. I thought it was like healthcare or something. So I don't care. I'm just getting my occurrences up. Right? FX actually allows you to do that, but it is somewhat limited. Okay? Shorter time frames also will help you with that. But the randomness plays a bigger role in shorter time frames. So we have to sort of balance that a little bit. But when we see people trading the daily and they're using one FX pair, it's going to take a long time for the sample size to really play out. Next bullet. The inability to accept the randomness results in questioning strategy, execution, and often strategy hopping. I know a lot of people aren't on video here, but I could probably visually close my eyes and see the people going, We've all done that. All right. But this acceptance where I don't know what's going on in my strategy. I got to tweak this. I got to tweak that. Right. It could be just randomness playing out. Right. The back test seemed fine. Now all of a sudden my strategy stinks. It must not work anymore. Different market. A lot of times it's just randomness. And then they go to strategy hopping and changing things. And then they're originally the code or your strategy was probably working well, but you changed it. And now you forgot the old code or it's a big mess. Understand that when you make changes and then you validate those changes, keep in mind that take a step back and say, is this just randomness? Right? And how do we solve that answer to eliminate the fact that it isn't randomness? A valid sample size. All right, fourth bullet. Measuring results over greater occurrences results in achieving expected results. By the way, it doesn't say it's going to make you rich. Expected results. So what do we expect? Well, maybe you want a certain profit factor, or maybe you want certain win percentage. The back test said if I do this and this strategy and should spit out 60% win and a profit factor of X or whatever. Over a greater number of occurrences, if you execute properly, again, it's a tall order, but the math will play out. That's what this is about. It's about math, the randomness theory, that randomness will reap its ugly head on every trade, but over a big sample, the numbers just work out. Okay, and the last one, I think that's the last one. Doing so also lowers the overall volatility in P&L. Talk about that in a second. Equity curves and reduces variance of backtested results to actual results. All right, that's a mouthful. I can't believe I wrote that. Let's break it down. Doing so lowers the overall volatility in P&L. Probably should be / equity curves. All right. So the actual results are going to be more smooth. It's going to be more expected, what you expect. So the equity curve is going to be more smooth. You have that nice little, that line like we saw in the previous slides going from left to right, lower to high. Right? Is that important? It's very important. You get more confidence because your results are coming out. It's more consistent. Your drawdowns are somewhat, a little less. They're more, tighter. All right. Your equity curve looks good, which is your greatest resume selling feature for getting funded. Wow. All of this from just pushing the button more. Pretty cool. And it reduces the variance of back-tested results to actual. Right? I think we talked about this last mastermind, and I mentioned it several. The gap between your back-tested results and your actual results. That gap is really your freedom gap. It's the gap between, okay, I got something that works, and if I can close that gap, I could live my life and all of the reasons why I wanted to be a trader. But that gap is preventing me from getting there. Well, what this is saying is, with a valid sample size, more occurrences on a strategy that has an expected positive outcome, the gap will close. How much will it close? In statistical theory, 95% of it will close to standard deviations. Okay, that's close enough for trader speak. So what you're saying is, Mike, that I'm having a problem with my strategy, it's not working, or the markets are too volatile, Russia's entering Ukraine. You're just saying push the button more? On a strategy that has an expected positive outcome, the answer is yes. Push the button more. When the trade is valid and it meets all the requirements. Okay? Or have the algo take those trades. Have a valid sample so you make an assessment, maybe expand, timeframes, markets, things like that. When I learned this about 10, I've read Trading the Zone probably 15 years ago, 20 years ago, but I just didn't understand it. I was just told that I had to read it and understand it. But when I realized, so all that's keeping me from reaching my goal is to have more valid samples so I can make proper decisions and then assess the gap. Well, it's a little more than that. But, and again, you have to execute with precision, as Douglas says. But you eliminate one of the biggest things that creeps into this dilemma. And that's, my strategy isn't working. I'm losing confidence. I lost 2 trades in a row this week. Right? And all this time, literally, I've seen people leave the business. 1, because they blew an account, or 2, because they just are frustrated. And all it was randomness, because a small sample size, randomness happened to get to them.
All right, so I hope you like it. A big topic here once again, and I know a lot of people won't understand it the first time, so maybe you have to go back and watch this video later. Same thing with when you read like Trading the Zone. The first time you read it, it feels like nothing's going right. It's boring. But when you go back to it later on, it's super applicable, and then you feel like all the things you've tried to learn before now work out really well. So hope that you guys have value out of this. If you want to join us in the academy, want to learn more about how we help traders to scale up and get profitable this year, check out the link below. It's going to be one link to see how you can apply and see what this program is all about, as well as the results our students tend to get from the program. So I would love to, of course, have you work with us. Get check this out if it's for you. And I'll catch you back here in the next video pretty soon. Don't forget to click the bell next to the subscribe button to be notified of future videos. I would love to help you out and have you get good results this year as well. And I'll catch you back here in the next video pretty soon. Ciao.